Interest payments on US debt are set to surpass defence spending. Japan's central bank now owns more bonds than anyone else in the country. And in France, they haven't balanced a budget since the 1970s. These aren't outliers. I would argue they're symptoms of a system that's drifting further from discipline and deeper into denial, threatening democracy in the West. If you're trying to protect your savings in this environment, the time to understand what's really happening is now. Do you understand? And if you do, are you prepared? This year, the US dollar has posted its worst first half performance since 1973. And if you're wondering what that means for your wealth, allow me to offer a clue. Gold is having its best start since 1980. For anyone still under the illusion that central banks and governments have the situation under control, these market signals suggest otherwise. Today's episode isn't just a critique. It's very much a call to recalibrate, to look past those polite fictions of modern economics, and then we're going to examine where our modern monetary system is truly heading. And here's a spoiler alert. It's not towards balance or discipline. It's towards ever more debt, ever less accountability, and an investment environment that increasingly resembles the theatre. But the good news, yep, there is some, trust me, is that you don't have to get caught up in it. So let's start with bonds. The so-called safe asset class has delivered its worst decade of returns since records began. The price of bonds are falling because when you buy a bond, you're effectively lending money to the government. And guess what? Less and less people want to do that these days. Whether you're holding US treasuries, UK gilts, Japanese government bonds, or German bonds, the story is the same. Negative real returns, vanishing yields, and investors who've paid for the privilege of losing purchasing power. The notion of bonds as a ballast of portfolio now looks almost quaint. The 60-40 equities bond portfolio is in trouble with portfolio managers who are increasingly looking at commodities and hard assets for diversification. And diversification, once the cornerstone of risk management, has devolved into an almost mechanical allocation exercise, ignoring the corrosive effects of inflation and central bank distortion. It is no wonder that increasing numbers of institutional investors and family offices are increasing their own exposure to physical gold. And yet, policymakers still insist that these markets reflect stability. The reality is that government bond markets have become a hall of mirrors. It's distorted by central bank intervention or obscured by this kind of accounting gimmickry and anchored in denial. And the risk-free rate, it's anything but risk-free, because when inflation eats more than the yield provides. The irony here is just too good. The very instruments designed to protect wealth have become tools for erosion. Bonds have transitioned from a source of income to a symbol of policy impotence. And now add in the central bank's increasingly desperate attempts to paper over these structural cracks and failings. In Europe, quantitative easing has all but destroyed the signaling function of sovereign yields. And in Japan, the Bank of Japan has become the market, with its balance sheet rivaling the size of the country's own GDP. If this is what modern monetary stewardship looks like, then someone somewhere needs reporting. Because even if central banks, traditionally big buyers of foreign bonds, are ditching them in favor of gold, then we all need to be paying attention. So if bonds are faltering, then what underpins them? Debt. US deficits are headed for 9% of GDP within the next decade, and that is a conservative estimate. The Congressional Budget Office has a curious habit of underestimating these figures, but even using their own numbers, interest payments alone will soon exceed defense spending. This is not a fiscal plan, although many probably would disagree. Instead, I like to think of it as maybe arithmetic entropy, a feedback loop in which debt service consumes more revenue, which then in turn demands more borrowing. We're told that this is sustainable because interest rates are low, except they're not anymore. The picture is equally bleak elsewhere. Do not be fooled into thinking it's just the US who has some serious issues. France hasn't balanced a budget in half a century. Italy, astonishingly, hasn't run a surplus since 1925. And again, this is not cyclical, it's structural. And it raises a very awkward question. How long can democracy survive if the political class is structurally incentivized to spend beyond its means? How long can a financial system survive when all those it relies on continue to up and up their credit limits? What happens when the credit card companies, i.e. the market, can no longer offer them more credit? The old model of financial repression, i.e. keeping yields below inflation to erode that real value of debt, that continues to break down. Yields are rising, growth is not, and demographics, particularly those in Europe and Japan, ensure that productivity will remain tepid. Even in the United States, the supposed engine of global innovation, the demographics are worsening. Fewer workers, more retirees, more transfer payments. Washington is engineering a system where each year the political appetite for austerity shrinks, even as the fiscal necessity for it grows. Now, one might argue that a new growth engine could emerge from, say, AI or technological innovation, and perhaps. But the belief that exponential tech progress will fix this kind of fiscal rot, well, that's a modern equivalent of cargo cult economics. And if debt monetization becomes the only viable policy tool left, then currency debasement is no longer a risk. It's the chosen strategy. And in such a world, the gold price does not merely rise. It's revealing the truth that newly printed money just cannot hide. There's a reason markets haven't revolted, because the pain of fiscal disorder is unevenly distributed. The top 1% own nearly half of all equities. The bottom 90% are largely locked out. But when it comes to housing, the story flips. Real estate is far more evenly distributed, which explains why governments bend over backwards to prop it up. This, incidentally, is why monetary policy is inherently political. Rate hikes affect mortgages, stimulus flows into financial assets, and asset inflation is not a side effect. It is the policy. So what emerges is a tale of two economies. In one, the financial class debates CAPE ratios over dinner in London's Mayfair, and in the other, young families struggle to rent, let alone buy. The former has lobbyists, the latter gets platitudes. But this generational skew in asset ownership is not just some odd curiosity of our time. It's a fault line. These older cohorts, politically powerful and asset rich, have every incentive to protect the status quo, whereas younger generations are saddled with debt, stagnant wages, and asset inflation, and they have none. So we're not in some financial imbalance, it's a democratic imbalance. Real wages have collapsed to extremes not seen in modern history. The average young adult today cannot afford to live independently, let alone plan for a future. The great promise of upward mobility has been replaced with precarious gig work, over-leveraged lifestyles, and the silent despair of a generation priced out of stability. Put simply, the dollar, pound, or euro is being silently devalued, buying you less and less, meaning that every hour you work is being devalued with the wages generated every week. Now, unspotted by many, the oil rig count in the US has suffered its fastest collapse since the pandemic. From January to July this year, rigs dropped 13.7%, and this was the steepest 15-week plunge since the pandemic. Now, don't be fooled into thinking that it's just about oil, because it's about so much, much more than that. Inflation, jobs, I could go on. And in the same month, the US margin debt rose by $87 billion to a record $1.01 trillion. When spikes like these have appeared before, it has been right before major market corrections. And what is everyone doing? They're borrowing like never before to buy more stocks. This appetite for risk is through the roof. Now, Robert Armstrong of the Financial Times captured this perfectly. He wrote the other day that speculative mania is alive and well, with crypto-friendly lending platforms like Divine Research offering unbacked microloans to the global poor, fueled by depositors chasing yield through stable coins. And Armstrong likens this whole thing to microfinance on steroids. So many point to stablecoins as some savior to our financial problems, but this is a red flag. It is not a revolution. And meanwhile, meme stocks are back. So is the retail frenzy. According to Citigroup's Lekovich Index, sentiment is overheated as it's been in the last 30 years, i.e. the levels last seen before the crashes of 2001 and 2021. And at risk of overmaking my point, this is not exuberance. It's denial wrapped in euphoria. And what are the really smart guys doing? They're tapping into their guts. They're turning to something that their investors have trusted for millennia. Google searches for gold just hit their highest ever level. People are waking up. And so where does all this leave equities? At an all-time high, of course, because valuation no longer matters. The CAPE ratio is near dot-com levels. Dividend yields are an afterthought, and yet investors pile in, convinced that a handful of AI stocks will deliver perpetual growth. But history teaches us that concentration is a prelude to correction. When Apple and Microsoft carry the S&P 500, we are not in a bull market. We are in a bubble. And the last time we saw this sort of imbalance, it was 1999, and pets.com still had a future. And we all know how that ended. Wall Street trades on liquidity and quarterly forecasts. Main Street, meanwhile, it clutches at stability. But with real wages falling, savings eroding, and debt soaring, the disconnect is just unsustainable. Gold needs no earnings call. It makes no promises. It simply holds its ground. The world is sliding into an inflationary recession. We're looking at stagflation once again. The next inflation spike will be more extreme than 2020. And of course, trusted gold, the canary in a financial coal mine, is already pointing to this. Assets will melt up further, but what follows? A hyper deflationary depression of a magnitude never seen in our lifetimes. Prepare yourself for some of the most extreme market movements you'll ever witness. And if you need help to do that, and if you're still asking why gold, well, you might be asking the wrong question. The better question is why not? So why not click on the link below and download your free guide today?